Good evening and welcome to the first session of our Spring Term Money Webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we are delighted to be hosting Brandon Davies. Brandon has enjoyed a 50-year career in finance, 32 years of which were with Barclays Bank, where he had been treasurer of retail and corporate banking and a member of the bank's executive committee. Prior to that appointment, he spent much of his career in investment banking, where he worked in London, New York, Sydney, Hong Kong, and Singapore, and was the first head of structured products at Barclays Capital. Brandon is a member of the Financial Markets Group at the London School of Economics and has sat on the advisor panels of the Professional Risk Managers Association and the Center for the Study of Financial Innovation. Brandon is currently a board director of the Responsible Finance Investment Foundation, which works with a number of banks to help Sharia-compliant banks with the ESG compliance. I should also say we are very fortunate to have Brandon as a trustee of the Institute. Today, we will discuss bank liquidity versus bank solvency, interest rate risk in the banking book.
Okay, thank you very much, Damian. Hello, everybody, and particular hello to my students that for the master's course in money banking and central banking, which I was giving the lecture on interest rate risk in the banking book late morning today. So it's particularly relevant for them, and I hope that this will answer some of the questions they had about how interest rate risk in the banking book relates to a lot of other risks that banks run. Basically, I'm going to look at bank solvency, bank liquidity, and the way in which both are affected, or both affect and are affected by interest rate risk in the banking book. But I won't be containing myself entirely to that, because in fact a chunk of the presentation will go quite a lot further. It's occasioned by obviously the collapse or recent collapse of Silicon Valley Bank. And that brought interest rate risk in the banking book right to the fore, because it collapsed very suddenly and resulted in a very rapid and rather amazing bailout by the US Federal Reserve. SVB, was the second largest individual bank failure after Washington Mutual, which failed in 2008. And New York-based Signature Bank collapsed 48 hours after SVB, was the third largest single individual bank failure in the US. So this was not small. These were not small numbers, and there really couldn't be a better example of that famous phrase from Warren Buffett, that you never find out who's swimming naked until the tide goes out. The tide in this case obviously being interest rates rising from historically incredibly low levels, unprecedentedly low levels, to something which looks far more like the average of interest rates. I think if you look back to around the Napoleonic period in the UK, you get a UK government bond rate of for sort of 5-year debt, 10-year debt of somewhere between 4% and 5%. So we're not talking about particularly high rates here, but we are talking about very much higher rates than they were previously. I'm going to focus on interest rate risk in the banking book because that's what I've been asked to do. But it wasn't the sole cause of the downfall of SVB by any stretch of the imagination. But losses on their unhedged holding of interest-sensitive assets did amount to about 15 billion, which is a pretty close match to the bank's paid-up capital base, which was about 16 billion. I'm also the bank was insolvent. I will also be covering liquidity issues, which, given the structure of SVB's balance sheet, were also very material to this bank's downfall. I wouldn't like you to go away, however, from this presentation believing that interest rate risk in the banking book or liquidity are, in my view, the only problems here. I think there are a lot of them. and I've got a list of weaknesses at the end of this this talk, which list, in my view, a number of the problems that particularly US banks and particularly US community banks have got. I'm going to do a brief explanation of interest rate risk in the banking book because it is extremely pertinent. And you know, SVB's brought this into focus. In particular, it's brought into focus this the holding of so-called risk-free assets, which basically in this case means US government-backed securities, or those that are securitizations of mortgages, MBS, known as mortgage-backed securities, which are conforming, that is, they conform to the requirements of Fannie Mae and Freddie Mac for rediscounting, etc. So, and it's never correct to call these things risk-free assets. They're always called risk-free assets. They're not. They're credit risk-free, or more or less credit risk-free. Certainly in the case of US Treasuries, the US Treasury can always print money, as can the UK Treasury or any other Treasury of a country. So in a national debt of the national debt of the nation can always be paid back by simply printing money, notes, and it might not be quite as simple as just printing the notes as we've seen with QE, but QE will also play a role in this presentation. But market value of such assets, because those assets are usually fixed rate, or at least in large measure are fixed rate assets, and a long term, 10 years is not at all untypical until QE, UK debt, UK treasuries, UK gilts had an average life of not far short of 15 years. So these are long-term assets and they are at long-term fixed rates. And that makes them very sensitive, as you can see from this following example. This is incredibly simple, but it's not a million miles away from a good picture of what can happen. Go back a couple of years, zero interest rates were pretty much the norm in the US. So, $1,000 bond has a future five-year term, has a future value of $1,000. If you move interest rates from 0 to 5%, you suddenly have a value of $784, or a loss of about 21.6% of the bond's value. So as you can see, fixed interest rate bonds are extremely sensitive to changes in interest rates, and the losses on them can be pretty eye-watering, particularly if they move as they have done recently. But it's not an unknown risk, and I think that's one of the things that surprises me a little, or more surprises me rather a lot actually, is that there's plenty of history lessons of the problems of interest rate risk in banking books and of the problems of holding long-dated fixed rate assets in American banks. Most notably, the bank failure, which we also, we'll go through on in the master's course. One of them is the American Savings and Loan Association demise of those banks, which happened really after the US Federal Reserve began raising rates very steeply, 1979 or so, and onwards. They had long-term fixed rate loans that were at a lower rate of interest than the rate of interest on which those banks could borrow. So they were lending out at long-term fixed rates at 3 and 4%, and interest rates had gone to 8, 9, 10%, etc. So basically their deposit base, which was short-term, they were having to pay up twice the amount of interest on that they were getting back from the assets that they'd lent previously. So in the period of the mid-1980s, really to the mid-1990s, there was a failure of about 1,043 out of 3,234 of these institutions failed. They had a total book value of 402 billion at the time. and it cost the US taxpayer a staggering 132 billion, which on a book value of 402 billion is one very, very large set of losses. And until Lehman's, this was the most costly bank crisis in history. So it's certainly not unknown to anybody who lectures or teaches on banking. So this problem of holding fixed rate assets, which will become problematic in a rising interest rate environment, was not unknown in the 70s. And the massive losses that could be caused by this, again, not unknown at all. And banks already had devoted substantial resources to managing this risk. The period of the demise of the S&Ls did obviously cause a lot of focus on this, and what evolved from that was basically something called asset and liability management, which was a major function then of treasuries, as bank treasuries, as the regulators pushed more and more for banks to disclose their interest rate risk. And this led to scheduling interest rate risk in the way in which, well, much more sophisticated versions of the simple example that I've got in this lecture, but also what it gave to was, what it produced was actually things called ALM programs, which were computer-based programs that held basically all the assets and liabilities of the bank and could revalue them against current interest rates in pretty much real time. So you could gauge offsetting assets and liabilities, and you could look at assets and liabilities both on a contractual basis, which I'll do a little bit of it, well, it doesn't take that much explaining, contractual basis, but also on a behavioural basis, which does take a little bit of explaining. A basic exercise on this aspect of bank risk management is included in the MSc program, and I'm going to leave you with an example of this to work out for yourselves. But what I would add is it's not a simple exercise where it's simple compared with the real thing, but it's still not that simple. I don't think I've actually managed to award full marks on it yet. So what I've done below is give you a very simple schedule from the sort of work that we do, sort of examples we give, so that students can work their way through it, and you can do the same. These sort of schedules, as I say, they passed into history a long time ago, and computer systems took over. In today, you can run any number of scenarios on both interest rate movements, customer behavior, and look at your what's known as gap analysis, the way in which you're funding the book and or funding the loans book. You can do this in pretty much real time, and you can do just about any number of scenarios you want. And importantly, what they show are two things. One is, and the most pertinent in this case, is that they show the economic value of equity, which is basically they take the losses that you are incurring through the gap risk in your ALM book, and adjust your equity for it, so reducing your equity. As you will see later, that becomes important. They also show something called net interest income, which shows you the profitability effects. Now, I'm not going to go through this example, but I leave it for you to have a look at, because I think it's an interesting, it's just interesting if you want to get your head around what interest rate risk in the banking book is. This is it, and it does give you a good example. And what you can see in the last one is what's known as a net mismatch, and the net mismatch shows you, and in this case we've got less than 3 month interest rates, so very short-term interest rates are, you've got a excess liability position over the assets of 3.75 billion in this case, 3.75 billion, and they're funding basically 3.25 billion of 3 to 6 month assets. So you've got a small gap there. Of course, if you're done this for SVB, what you would have is well, many billions in this first bucket here, this first part of the schedule. And if you go to the far end, because it will be in excess of 5 years, it'll be in the 6 year plus, you ought to have had some very large numbers matching it. That is a gap you will not see, well, you won't see it for long, in any bank subject to Basel regulation, because your regulator or your supervisor will pretty soon close you down if you did. So basically, the net mismatch shows the interest rate open position, that is assets minus liabilities in each period. What you've got in a bracket, in brackets, is a short received position, i.e. you are funding, you're funding your book short and you're lending long. And your net interest is the difference in the interest rates that you're charging on the assets versus what it's costing you to fund those assets in the deposits. And of course, running long dated fixed rate assets, as long as nothing changes, yield curves are positive. So, and as long as yield curves are positive, but they are most of the time, then running long-term assets on short-term funding looks like a profitable business. Until interest rates change, it is. When interest rates change, it can be an extremely dangerous business. So basically, what we have is that if you have this position that we're showing in these ones, the short interest position, then profitability is going to rise when interest rates fall, but correspondingly, it's going to fall when interest rates rise, and that's exactly the trap that SVB ended up in. The above example, I guess, suggests that interest rate risks is a bad thing. Rising interest rates are a bad thing for commercial banks. That's not always the case. Indeed, most of the time, they can, for a period, be a very good thing, because you're going to make more profit as long as you're not running a lot of gap risk. If you are running a lot of gap risk, you're in trouble. And what we had here and with SVB was that it would be holding long-term fixed rate assets, and it was funding them with very short-term liabilities. Now you can hedge these positions using interest rate swaps. So basically saying, well, I'll swap my short interest for long interest through a derivative contract, and that you can certainly do. The problem is, of course, that it kills off your P&L effect. What has kind of surprised me quite a lot is the extent of what appears to be the extent of open positions in US banks. The US Federal Reserve said American banks had a total of $620.4 billion of unrealized losses on their securities portfolios at the end of 2022. Including some $340.9 billion on bonds that they don't plan to sell. We're going to cover that just in a moment, because this is something that I've been particularly concerned with when we get explanations appearing in the press of what's going on, because I think they're usually deficient in this area. It is interesting, of course, that the ECB and the Bank of England have both been looking at what this will mean for European banks. And basically, they've come up with a figure of, they think that the amount of risk in European banks due to current interest rate movements is around 3% of their capital. So basically, a 3% reduction in the capital of the bank. Of course, in the case of SVB, it went from basically to zero. So how come the European banks are in such a different position? Mainly, it's because they are subject to Basel regulation. And I've got the figures in here somewhere, but it's not a surprise to me because I know it, but I hope it will be a surprise to some of you, the difference in the number of banks that are subject to Basel regulation in Europe versus the US. In the US, there are 14 banks subject to Basel regulation. In Europe, there are 2,200. So it's a completely different regulatory environment. Interest rate risk in the banking book falls under three aspects of Basel. One is the Pillar 2 regulation, which I'll very briefly mention, and secondly, some Pillar 1 regulation. Basel comes in 3 pillars. One is a capital calculation, or the other one is things that are risks and will be degenerated potentially into capital, but sometimes managed other ways. Interest rate risk in the banking book is one of those, as well as, interest rate risk in the banking book, interestingly, in European terms, is covered by both Basel 1 and both Pillar 1 and Pillar 2. And in fact, it's also covered by Pillar 3, because Pillar 3 is disclosure. And what you have to do for European banks under Basel is that you have to do your calculations under Pillar 1, do your calculations under Pillar 2, and then you publish. So, and another reason connected to banks, and something that we went through in our lecture, David, I haven't got time to go through here, is the very peculiar way in which, very specific way in which mortgage-backed assets in the US, mortgage-backed securities, are such a huge market and such a big feature of American banking. Very different from Europe, because the risks in American mortgages are just completely different from the risks in European ones. But do you notice, when you go back and have a look at that schedule, one of the things you're going to notice is that there's something missing. Nowhere does that schedule mention anything to do with accounting rules. It's simply interest rate risk. Where are the assets and the accounting categories? So in accounting categories, you have 3. There's held for trading purposes, which are assets that are marked to market through P&L. There's available for sale, which are marked to market and taken as adjustment to capital. And there is held to maturity, which are only expense through P&L if they are sold. So where does that appear in regulation? Well, it doesn't and it shouldn't. ALM systems take no account of accounting rules, and neither should they. ALM systems are risk management systems. They're not accounting systems. So a lot of the comment on SVB seems to me to confuse accounting rules with Basel. And if you're not subject to Basel, well, I guess there is some reason for saying that some of these assets are not expected to be sold. But under a Basel regime, that just doesn't, the regulation takes no account of that. All assets are simply valued effectively back to their mark-to-market value. What an ALM system shows is basically the change in P&L and the equity value of the bank, given any change in interest rates on its entire asset and liability structure. Now, what you might want to ask is, okay, so how do we look at these assets and liabilities? What assumptions are there? Because whilst many contracts banks enter into are very specific and market contracts, a lot of them are not. A lot of them are contracts that are subject to behavioral. We all behave in a certain way with respect to our bank accounts. If you've got money in the bank on deposit, say 30 days, and you go into the bank and say, I need my money, are they going to give it to you? Yes, they are. They just ignore the contract. They might penalise you a bit for some money for taking it out early, but basically the contracts don't behave in the way in which they are originally written. And therefore, regulators take a lot of note of that and expect banks to look at the behavioural characteristics of their entire books. How do people behave versus what are the contracts? And that's particularly about the retail market rather than wholesale markets. Obviously, in wholesale markets, people are expected to conform to their contracts. So they must be honoured, but and repricing ladders will show that. But retail products are subject to these adjustments for behaviour. I think we've just done this, but so, and the big issue with deposit balances in saying, well, what happens to them in the Pillar 2 type regulation where we're looking at behaviour, is that basically if you have uninsured deposits, now insured deposits are those that come with a government guarantee, and those come in the UK, government guarantees up to £85,000 of your deposits with a bank individually. In the US, I think in Europe, it's 100,000 euros, and in the US, it's $250,000. So it's very big in the US, but anything above that is uninsured. But also, it requires these deposits, if they are insured or not, to be held in transaction accounts. So basically, the only ones that you take as sticky, i.e. unlikely to disappear in an instant, are those deposits which are guaranteed under the guaranteed amount and in a transaction account, which is basically a current account. That's because you and I put our money in. It is largely you and I current accounts that are in this. You and I put our money into our wages into our current account and make payments from it throughout the month, etc. So we're using it as a payments mechanism. Anything other than that, it's assumed that deposits are immediately withdrawn. So if it's over the guaranteed amount, or it's not in a transaction account, then it's assumed that that disappears instantly. We've got those guaranteed amounts. If they are within those parameters, fairly sticky, but if they're not, they're guaranteed to disappear pretty quickly. If we look at SVB, well, 94% of its deposit liabilities were not insured. So one of the things this tells us is that you can get a lot of concentration in deposits in the US in balances that in BAL terms will be assumed to simply disappear in an instant once any problems arise, and therefore are not counted as sticky, or not counted as likely to hang around and support the bank. So that accounts for two things. One is the huge size of that, 94% of its entire deposit base being in excess of $250,000 and not in transaction accounts, accounts for why, when the Fed had to support SVB, the first thing it did was insure all the deposits. Now, no bank is perfectly liquid. I think, there will be innumerable examples. I'm just going to do a lecture in a week or so's time on the Mississippi company crisis, which was a banking crisis in France in 1720, which has at its heart that problem. They've been around like forever, and banks, basically, if they are needed to be made liquid, entirely liquid, there are really big problems with it. The amount of cash banks keep is very small. It's basically the cash in cash machines. There isn't a lot. You keep a few million, but it's well, a few tens of millions, but it's not a big number. Basically, you keep reserves at the central bank, and in normal times those reserves are quite small, actually, because all they're really there to do, largely there to do, is to ensure that when you need to make payments to other banks, because more money is flowing out of your bank and into somebody else's, you're able to make that payment directly through your reserve account, which is your account, your bank's account with the Bank of England, and into another bank account with the Bank of England, so Barclays paying Lloyds or whatever. And these balances are there to do that. Now, in both cases, in normal times, they're pretty small. Reserve balances have grown dramatically, actually, because of QE, and but that's an explanation I don't really want to get into today. But they have. But anyway, only for certain banks as well. So you've got these payments amounts. Life gets more difficult once you start going to other places than that for looking to raise money as a bank. You could curtail your trading activities. I guess you could stop them if you really had to, but that's not going to release very much cash, because basically you fund a trading book on a repo basis. So basically you match fund the trading with repurchase agreements, because that way it's overnight money, and it's secured on the assets that you have in the trading book. So basically that means that there's very little in that trading book that is your money, except for the capital that supports it, and the capital will be maybe 20%, but it's not that large. You can sell your loans book if you're in desperate need, but unless you're running a securitization program, it's going to be pretty hard to do that. People don't buy your loans book without looking very thoroughly at it. That takes time. So basically, that doesn't work very well. You could stop making new loans, but that's not going to save you very much. You can sale and lease back. Well, sorry, you can sale and lease back your fixed assets, but actually you've already done that, because any capital that supports premises in a commercial bank is not available to support lending, and so basically you want all your capital to support lending because it's much more profitable. So it's the basis for your profit. So basically that's already been done. You could enter into commercial repurchase agreements for any securities you hold, and this is where really you're going to raise the cash. Those held for trading purposes will produce very little, because that will nearly all be on repo. If you're holding assets for held for trading purposes under your accounting name and your accounting designation, then you're not going to raise very much money because you've repoed it already. Those held for sale will produce cash in very substantial quantities, and they're already marked to market. So any hit to capital will only be what's additional to probably reflecting the fact that you're a bit of a forced seller. But that's going to be relatively small. If even SVB against the size of US markets is very small. So basically, you're not going to move the price much. So that's a very good source of thing. This is where the problem comes. If you're not subject to Basel regulation, you could sell, or you'll have to sell if you're pushed for it, and that's what happened to SVB. You will have to sell those assets that are held to maturity in your balance sheet, in your accounts, and but that has a problem, because once you sell those, they all get marked to market, and that's where you realize these huge losses. Now we'll come to my conclusions to what I think of this, but that's basically the problem that SVB got into, and you suddenly get this massive hit to capital. The other thing you can do, and normally will be forced to do, and SVB is that you're going to approach your bank for emergency liquidity. Now, that's normally the beginning of the end. A central bank will advance funds to you, but at a high price and after haircutting the asset values. So you will get your liquidity, but it will be very expensive, and it will soon tell whether you are solvent or not. And in the case of SVB, it became very obvious, I suspect, even before they got any emergency support at all, that this was an insolvent bank, not just an illiquid one. Also, telling illiquidity from insolvency sounds easy, but actually in practice it can be pretty difficult, because you don't know what the bank's assets will be worth. An interesting sort of example here is that Lehman Brothers was eventually wound up and had a positive equity value, but it just took an awfully long time. Basically, the support that the Fed had to give SVB was extraordinary. What it did was jump in and not simply agree to guarantee all of its deposits. So it brushed aside the $250,000 US limit and just said all deposit balances for however big they are, they're all guaranteed now by us, by the authorities, and it also gave cash to the bank on the basis of the nominal value of the treasuries and MBSs that it held. And that's really extraordinary, because basically the Fed was taking on the interest rate risk in the banking book of that bank. It's an extraordinary level of support, and I've certainly never seen that before. Now, if you are in this situation, basically, and every treasurer has to consider, you might one day be, you never know. Basically, what you do is play for time. But in that case, you have to remember the markets might not cooperate with you. Once your central bank is intervening, supporting you, in many ways, once that becomes known, confidence in you tends to drain away very, very rapidly. And that then the end of banks comes slowly and then very quickly. So just a quick, brief look at Basel regulation, because I've mentioned it so many times and it is so important here. There's a Basel Committee banking supervision standard on interest rate risk in the banking book, and if you click on this little icon I've left in the in this presentation, you will get the updated 2016 version of it. It does refer back to the original 2004 version occasionally, so you might want to try and get that as well. You just have to Google it. It's not that difficult to get hold of. And that's all about this Pillar 2 framework for looking at interest rate risk in the banking book. And it basically, the approach of the regulators is that one is that you have to calibrate it. So they will be expecting you to have an ALM system that gives a very clear view of the amount of interest rate risk you're running. You are expected to shock and stress test that. You're expected to do behavioral modeling and make the assumptions very clearly about your behavioral assumptions very clearly stated. You need an internal validation process to be undertaken on the modeling you're doing. So you can't just say current accounts will do this. You have to explain why they will do that and give some evidence as to why they are. You will have enhanced disclosure requirements will be implemented on it. So that means that you actually have to disclose an awful lot about the models you're using. And banks must disclose the impact of interest rate shocks in both their economic value of equity and their net interest income. So basically you have to show both. And supervisors must publish their criteria by identifying outlier banks. And in this case, under Basel, outlier banks are banks where the change in the economic value of equity is more than 15% of its Tier 1 capital. Now, given that SVB was about 100%, it shows you, there's a very big, this is pretty tight stuff. There are supervisory or regulatory capital consequences of inadequate management of the interest rate risk in the banking book. So if the supervisors don't think much of your models or don't think much of what you're doing, basically they're going to raise your regulatory capital. And very importantly, and this is where the US banking differed so much from European, supervisors have national discretion to apply interest rate risk in the banking book to non-internationally active institutions. Now, basically, in Europe and the UK, it's applied to virtually all institutions. Very small ones get away with it, but you have to be very small. It basically applies to everybody. Whereas, as say, 2,200 institutions is across Europe. In America, it only applies to the 14 largest institutions. Our regulation and liquidity. I'm not going, again, to go into too much on how banks monitor liquidity. Partly because it's both complicated and it's very bank specific, and we cover it in the MSc course in a 2-hour lecture, which I'm sure all my students listening to this are just dying to listen to. But it basically, once you get, you've got the Pillar 2 stuff, the modeling of interest rate risk in the banking book, but then you've also got 2 Pillar 1 requirements. One is called the liquidity coverage ratio, and the other one is the net stable funding ratio. The liquidity coverage ratio is basically a test of short-term robustness. So it means that a bank must be able to withstand a bank run for 30 days. And a bank run is basically all the likely outflows are expected to happen, plus a stress test on them. So things that wouldn't normally happen are expected to happen. And then your income is expected to be virtually nil, or income in cash is expected to be virtually nil, except loans that are running off. It's a bit more complicated than that, but that's the basic essence of it. And any difference, and there will be quite a big difference, you're expected to cover with 100% of your 100% of that difference must be covered by a holding of government securities, and those government securities must be marked to market. So basically, you've got to hold something which the regulator, the central bank, can step in and turn into cash and have no liability other than to the government on. Weighting of these inflows, outflows varies between 0 and 100%, and much more is at 100% than 0. And what happened is the run problem is something that central banks have focused much more, the supervisory functions within them have focused a lot more on in recent years, because it's become aggravated by the fact that banks are becoming much more computer driven than they were digital driven. And very basically now you can activate your current account 24/7, 365. You know, your current account is there all the time. So if you want to transfer money out of it, you can do it at any time. Now, the crucial problem, as far as I would suggest, with SVB was that it wasn't subject to Pillar 2 IRRB regulation, nor was it subject to the LCR, nor the NSFR. Net stable funding ratio is basically says match your long-term assets with long-term liabilities. So basically, this bank was not subject to any of this regulation, something that Mr. Trump removed all banks, all US banks with less than 250 billion balance sheet, assets, but liabilities equal assets, so it's the same thing. 250 billion of assets. Anything smaller than that didn't have to comply with any part of this. Now, I said I've given you quite a lot on interest rate risk in the banking book and liquidity. And I said I'd focus on those and an explanation of them, and because they were it was the fundamental cause. But I think there's a lot more in it than just that. So my conclusions, and there's quite a lot of them, we're going to look at a number of things. Firstly, kind of a bond, running a bond book, and I used to run bond books for trading operations at Barclays. The 101 is you shorten your duration when interest rates cycles, when you've got a hike, when interest rates are rising. It seemed to be somewhat unknown to the SVB management and board, and perhaps more to the point, it probably wasn't unknown, but why was it ignored is an interesting question. This graph below just shows you the size of the difference between available for sale and held to maturity securities in US banks, and just how big the portfolios are. They're huge. My second conclusion is that raising insurance levels won't cure the underlying problem. Basically, US banks have 7.4 trillion of deposits that are insured, up to $250,000, so much higher than in the UK or in the EU. 7.4 trillion of deposits that are insured, but 10.5 trillion of deposits that aren't. And what you can see here is the huge rise in deposits over the last years, and particularly since QE, because there we are in 2019, 2021. Huge rise in QE, huge rise in money supply. And I'll come to that in a moment, because that I think is one of the most fundamental underlying causes of this problem. Community banks are still under pressure. There was an extremely good and rather long article in the FT on this point, and where they looked at a whole string of banks which they thought might be in trouble. You know, First Republic is one case in point. It had low cost deposits, but uninsured deposits. Most of these deposits were uninsured. It has raised 109 billion from the Fed on a basically 200 billion balance sheet. So gives you some idea of how much liquidity has been pumped into it. But concentration risk applies to so many community bank assets and liabilities, and particularly to their holding of mortgage-backed securities and commercial real estate loans, CRE loans. And these are two things to watch, particularly commercial real estate loans, I think, because the credit risk also is looking very problematic. But if you look down there, you start to see, if you get this article out, the FT, you start to see where a lot of the concentrations are. So part of my proposition here would be that this crisis is still rumbling on. It's not gone away by any means. My fourth conclusion is that executive pay and the incentives it can set up are a problem. And that can only be mitigated by a malice and clawback regime. Now, the UK, not the EU, the UK alone has what's known as the UK, it's called the SMCR, Senior Manager and Certification Regime. And basically that pushes concepts called malice and clawback. If anything goes wrong with your bank, you're going to get a whacking rate debit to your, not just your existing or prospective bonuses and salary, but it can be clawed back from you for past years. Basically, UK senior management does have significant skin in the game, and particularly so compared with the skin in the game that the executive of XVB had. What we can see here is that the bonuses pushed the CEO's remuneration to 10 million in 2021, which is 60% up from 4 years earlier. And the CFO's was 3.8 million, which was double 4 years earlier. And they paid again virtually the same amounts in 2022. And in that year, SVB's stock had fallen 66%. And that tells you something about the way in which the market looks at interest rate risk in the banking book. The market knew these banks were in problems. Basically, my conclusion 5 is that all assets and liabilities in bank balance sheets should be carried at fair value. Now, I'm a fairly recent convert to this because I've had a much more nuanced view for most of my life, but and my career. But I've become a convert to saying, hell, we need to make it clear to everybody that whether a bank is solvent or not solvent. Now, my reason for changing sides is that if you are subject to the full rigors of the Basel regime, it's really not going to make much difference. The Basel regime is so disclosive and so invasive of what your interest rate position is and how it affects your value as a bank, that actually publishing it isn't going to make much difference. Publishing it, put everything at fair value, isn't going to make much difference. I also think that they should publish a clear statement of their liquidity position. And again, Basel regulation on this under the LCR and the NSFR means that that's not going to make, again, much difference. I think systemic risk needs a rethink. It's basically always been based on the size of the institution. But I think we first saw with, well, certainly my thinking on this goes back as far as Northern Rock, is that Northern Rock wasn't a very big bank when it went bust, but it's certainly had systemic risk overtones. Not as bad as SVB, I think, because I think the problem there is much more widespread. I think we're fairly lucky that, well, not lucky, but the nature of the market was that that Northern Rock was pretty much an outlier. bank, whereas I don't think SVB is anything like as much of an outlier as Northern Rock was. Scenario and stress testing regimes need to be independent of political and herd behaviour influences. And herd behaviour, I think, does affect a lot of people: central banks, treasuries, regulators. I think the letter by Jamie Dimon from was interesting in that he pointed out that none of the 2020 Fed stress tests had a rapid increase in interest rates in them. Yet at that time, I will point out that a lot of other people were thinking very differently, including us at the Institute of International Monetary Research. So if you go back to 2020 and look at our publications, you will see that we were forecasting very steep rises in interest rates. And the Pillar 2 mandate, or Pillar 2 mandated banks under Basel had to do stress tests in those years of a 2% rise in interest rates, despite the fact they were basically zero. So it was 0 to 2% rise. So captured quite a bit of it, substantial amount. And of course, it's 2% each time, actually. They just add on 2% each time. Basically, I think the reaction of regulators and central banks and treasuries to SVB and to Credit Suisse, I would add, but I'll save that for another day, I think have set some pretty bad precedents. Letting banks fail is a good thing, but you've got to make sure that if they do fail, firstly, you've got to make sure you don't have a systemic problem. And I'm not convinced the US hasn't got a systemic problem here. So I guess that may be their excuse for, a riposte to my position might be, we couldn't let one fail because this is not just one bank's problem, it's a lot of banks' problem. But if you repeated their reaction to it, which is supporting all deposits and taking on all interest rate risk in their banking books, it begins to look more like nationalisation of the banking system, and or at least a chunk of it. And I think if that sort of support is necessary, even for a relatively limited number of not insubstantial institutions, it's probably a sign that you've got a really big problem with the system. If the US community banks can't be profitable without running these kind of risks, I think it's time for a major consolidation. And if you look at US banks, by the way, there are about 4,500 of them subject to the Federal Deposit Insurance Corporation. That's a very large number of banks, and a very large number of relatively small compared with really big boys banks. So America has a very diverse banking system, and there's only one free lunch really in risk management. At least the way I teach it, there is only one, and that's diversification of deposits, diversification of assets. That's very hard to do if you've got a lot of regional banks and a lot of community banks. They're bound to be very focused in their communities. So, and the other thing I would say on this rescuing banks is that if you're going to do it in a more regular, a more conventional fashion, which is that if banks need emergency liquidity but aren't insolvent, then you need to make the discount windows of central banks open 24/7, 365, because runs are 24/7, 365 these days. I don't think community banks should be subject to low standards of regulation. The idea that only 14 banks in the US are subject to Basel III regulation seems to me to be nuts. Europe's got 2,200 of them subject to it. It's a much more sensible way to be running your banking system. it's clear that banks of 250 billion can be systemic, and say the FD covers 4,200 institutions. I think that the big, on a broad picture, a sort of macroeconomic position, the whole banking system, wherever you are in the world, or at least wherever you are in Europe, the US, and a fair parts of other countries as well, but the banking systems are suffering from a hangover from the QE party. The accumulation of bonds and subsequently, therefore, interest rate risk in the banking book by US commercial banks is in large measure a hangover from quantitative easing. The money supply rocketed up. That means deposits in commercial banks rocketed up, and you can see that from a graph, the second graph that I put up on these conclusions. Those banks couldn't lend out that level of deposits. They don't have that many people coming to them with really good propositions for a loan. So basically, they accumulated these deposits into mortgages, mortgage-backed securities, and government bonds, and taking on interest rate risk in order to earn a return on them. And that basically sowed the seeds of this current community banks crisis. So I would go back and say a big part of the problem here is quantitative easing. I have noticed from the press in the last few days, the Bank of England seems to think it's a good idea to raise the deposit guarantee from 85,000 in the UK. I don't see that there's any evidence whatsoever from the US much higher guaranteed amount of 250,000 US dollars. What's that, about 200,000 pounds? That stopped the run and did nothing. It was quite clear that the run happened despite that. So the only thing that stopped the run was really a guarantee on all deposits of all amounts and taking on the interest rate risk. So I don't see that raising the deposit. Basically, I don't see depositors wanting to keep their balance within any of their balances with insolvent banks. Who would? Whatever the level of the deposit guarantee, it's only going to end up with, it's the possibility is that you will end up with some kind of discontinuity in your banking transactions, and nobody's going to want that. So basically, when we saw with Northern Rock that people took their deposits out despite the fact that there was a guarantee, they were well under the guaranteed amounts, they still all took their money out. Why? Because they don't want the disruption, they don't want the hassle. So basically, I think what we did see with SVB UK was that a swift engineering of a takeover solved the institute by a demonstrably solvent institution, in this case Hong Kong Shanghai Banking Corporation, worked very well. So I'm worried that a lot of this talk about the 85,000 and stuff is really about trying to create more competition in UK banking rather than about, and it becomes, if we're not careful, just a way of subsidizing competition. And I don't think that's a very good idea. If banking doesn't become, a competitive business, there's some good reasons for it. And as I say, my own take on that is the big reason for it is there is only one free lunch in risk, and that is diversification. And you can't diversify if you're a very small institution. You're going to be local in some way or the other, or concentrate in some way or the other. So I think big banks have very real advantages.
Well, thank you, Brandon. I mean, I know you're a very busy person, so we do appreciate you taking the time to come and speak to us tonight. And with that, I wish you a good night and thank you.
Thank you. Thanks very much. Goodbye.